Thrift stores pulled in $13.7 billion last year. The average store keeps 4.1% of every dollar. 80% of new stores fail within 2 years. Here is the strange part. The inventory is free. Every shirt, every book, every piece of furniture costs them nothing. And that free inventory is exactly why they fail. Here is what makes that number impossible. The industry pulls in $13.7 billion annually. The average store runs on a 4.1% net profit margin. That means a location generating $300,000 in revenue keeps roughly $12,000 after every expense is paid. A manager at a fast food restaurant earns more. And yet people keep buying these businesses. A real purchase example shows a store requiring $420,000 just to acquire the operation and fund the first year. That includes an SBA loan, seller financing, and cash. This is not a simple shop purchase. This is a debt structure with a storefront attached. Before a single item sells, the buyer must navigate a regulatory maze that varies wildly by jurisdiction. Some states require a second-hand dealer license with fingerprinting and background checks. Others demand a separate pawn license if certain electronics are accepted. The holding period creates its own trap. New York requires 30 days before resale. California demands 15. Texas allows 7. That inventory sitting in the back room generates zero revenue while consuming storage space and tying up labor. Police retain the right to inspect records without warning in most jurisdictions. The ledger must include item descriptions detailed enough to match stolen goods reports. Zoning adds another layer. Some cities cap secondhand store density at 1 per commercial district. Others classify them separately from general retail and require special use permits that can take months to acquire. The license application asks if the business will accept jewelry, electronics, or musical instruments. Answer yes, and the compliance burden doubles. Answer no, and half the valuable donations become illegal to resell. The National Association of Resale and Thrift Shops reports that roughly 80% of new consignment shops fail within the first 2 years. That is not a retail failure rate. That is a restaurant failure rate. Something about this business model is fundamentally broken. But the industry still grew to $13.7 billion. Where is the money? The fantasy is seductive. People drop off unwanted clothes for free. Someone hangs them on a rack. The public pays to take them away. Zero inventory cost means enormous margin. The whole operation appears to run itself while the owner counts cash and feels good about saving the planet one donated sweater at a time. That fantasy dies the moment the actual costs stack up. The inventory is free, but the labor to sort it is not free. The labor to clean it, price it, and hang it is not free. The space to store it is not free. The disposal cost for the 30% of donations that are unsellable garbage is not free. Every bag of donated clothes arrives with a hidden bill attached, and that bill comes out of the margin before a single item sells. The average transaction value at the register is $32. A store needs a lot of customers walking through the door just to cover rent. A well-located store can pull in $25,000 in a single month. That sounds like a business, until the costs start stacking. But that assumes the donations keep arriving. That assumption has a problem. The lease alone can eat $4,500 every month. Add wages, utilities, insurance, and payment processing fees, and the fixed costs climb past $20,000 before the first item gets priced. The inventory might be free, but the labor to process it is the most expensive thing in the building. A store that size needs a manager, 2 sales associates, and someone in the back sorting donations. That team eats nearly $15,000 every month before a single utility bill arrives. Payment processing fees take another 2.5% to 3.5% of every card swipe. Workers' compensation insurance, general liability coverage, and property insurance add their own monthly drain. Now add the seasonal reality. Summer donations surge as people clean closets, but summer sales drop as customers vacation and shop less. The owner pays staff to process inventory that will not sell for months. The gross margin looks heroic on paper because the inventory is free, but the operating costs are the real story. And there is another cost nobody mentions until it destroys them. Every item that does not sell still costs the labor to sort it, the space to store it, and the utilities to keep it lit. Shrinkage runs between 2 and 4% of sales because the self-service environment is impossible to fully control. Customers steal, employees steal, and the inventory is so varied that nobody can track every single item. The utility costs scale with square footage in ways most buyers never calculate. Electric bills run $3 to $5 per square foot annually for a space that must stay lit 12 hours per day. HVAC adds another $2 to $4 per square foot because customers will not shop in extreme temperatures. Insurance premiums range from $2,000 annually for a small operation to $8,000 for a larger store with multiple employees. Point-of-sale systems carry monthly software fees of $80 to $200 depending on inventory tracking complexity. Credit card processing takes its cut twice when customers use rewards cards because the interchange fees climb to 3.5%. Textile disposal becomes its own line item. Recyclers pay 3 to 8 cents per pound for unusable clothing, but the store must sort it, bale it, and arrange pickup. A location processing 2,000 pounds of donations weekly will generate 600 pounds of unsellable material that produces roughly $30 in recycling revenue while consuming hours of labor to prepare. The industry average net margin sits at just over 4%. That means a store generating $300,000 in annual revenue leaves the owner with roughly $12,000 before paying themselves. This is not a business purchase. This is buying a job that pays less than minimum wage per hour. But wait, if the margins are that thin and the failure rate is that high, how did this become a $13.7 billion industry? The answer is not on the floor, it is in the back room. Take a single vintage designer piece that a donor dropped off for free. That item does not go on the rack with the $5 shirts. It gets photographed, listed on an online marketplace, and sold for $200 to a buyer 3 states away. The platform takes a 12 to 15% fee, but the inventory cost is zero. The margin on that single piece can approach 90% before labor. Meanwhile, the floor inventory carries the same labor cost with a fraction of the price point. The back room becomes a sorting operation where every donated item gets graded. The top 5% of what comes through the door gets listed online and sold to a national audience. That 5% can pay the rent for the entire month. This sounds like the solution. It is not. There is a reason most stores cannot replicate this model. The other 95% of donations still need to be processed, hung, and displayed. Most of it will sell for a few dollars each. The operation runs 2 businesses inside one lease, and the one that pays the bills is the one that looks like a warehouse, not a store. A $5 shirt on the floor moves slowly and barely covers the labor to process it. A $200 designer coat sold online from the back room generates more profit in one transaction than 50 floor sales. The sign outside says Thrift store, but the money comes from something closer to online arbitrage. The owner is a vintage dealer who happens to have a retail front. Photographing and listing each piece consumes 15 to 20 minutes when done properly. That includes measuring the garment, checking for flaws, writing the description, and uploading to multiple platforms. A single employee can process maybe 20 items per day if they do nothing else. Photography equipment alone runs $500 to $2,000 for lights, backdrop, mannequin, and camera. Shipping materials cost $2 to $4 per item for boxes, tissue paper, and branded packaging that buyers expect from premium resellers. Return rates sit between 8 and 15% because online buyers cannot assess fit or condition in person. Each return costs the seller twice because the platform keeps its fee and the shipping expense is already spent. The platforms themselves operate algorithmic ranking that rewards volume and consistency. A seller who lists daily ranks higher than one who lists weekly. The competition includes thousands of other resellers chasing the same vintage designer pieces. And here is the core problem. 95% of donations cannot be sold this way. The condition is too worn. The brand is too generic. The style is too dated. The online model works only for the tiny fraction of donations that possess specific characteristics. Premium brand recognition, current style trends, pristine condition, and desirable sizing. Everything else still goes to the floor at $5 each or into the textile recycling bale. Which raises the obvious question. If the back room makes all the money, why not cut out the storefront entirely? This is why stores that look busy at the register can still be bleeding cash. The visible business is not where the profit hides. The floor is a cost center. The back room is the revenue engine. And the real asset is not the inventory at all. The real asset is the donation pipeline. Goodwill and the Salvation Army dominate the supply of free inventory in most markets. They have spent decades building collection networks with massive brand recognition and thousands of locations. A for-profit store is not competing for customers first. It is competing for donations first, and the charity giants have a structural advantage that cannot be matched. A for-profit store cannot legally offer donors a tax deduction for their goods. A nonprofit can. That single difference redirects the best donations to the nonprofit stores every single time. People donate vintage designer pieces, antique furniture, and high-value electronics to Goodwill because they get a tax write-off. The for-profit stores get the leftovers. The stained clothing. The broken electronics. The items the charity stores rejected. The donation bin is the intake valve. Control the donation flow, and the business is controlled. Lose the donation flow, and the store is just an expensive room full of other people's discarded lives. The nonprofits control the valve. Goodwill operates over 3,000 stores across North America, with brand recognition that reaches 92% of the population according to industry surveys. The Salvation Army runs a fleet of donation trucks that cover scheduled neighborhood routes like garbage collection. Donors receive a tax deduction valued at the fair market price of their goods, which can reach hundreds of dollars per donation load. That tax deduction difference is not marginal. It is existential. A donor with a vintage leather jacket worth $200 can deduct that amount from their taxable income if they donate to Goodwill. The same donor receives nothing but a thank you if they donate to a for-profit competitor. The nonprofits market their donation programs through community partnerships, workplace giving campaigns, and donor appreciation events. They position donation as charitable giving rather than disposal. The brand promise is that the donation supports job training programs and community services. The for-profit stores market with yard signs and Facebook posts. The competition is not even close. The nonprofits capture the premium 5% of the donation stream before a for-profit operator ever sees it. This is why the Savers case from Minnesota matters. The state sued the largest for-profit thrift chain over how it collected donations and represented its charitable partnerships. The Attorney General alleged the company misled donors into believing their goods were supporting local charities when the stores were operating for private profit. More than 1,000 consumers filed complaints with the FTC about the practice between 2009 and 2014. When the state comes after that model, it does not sue the charity partner. It sues the company that controls the bins, the trucks, and the storefront. The settlement costs, the legal fees, and the reputational damage land on the owner's balance sheet. The purchase includes not just inventory and leases, it includes every promise the previous owner made to the public. And that brings us to the catastrophic risk nobody sees coming. Every donation that arrives at the loading dock carries a provenance that cannot be verified. Nobody knows where it came from, who owned it, or why they got rid of it. The secondhand dealer license that most states require exists for exactly this reason. The law expects the owner to maintain a purchase ledger with detailed descriptions and seller identification. Some jurisdictions require a holding period of 7 to 30 days before anything can be resold. Police can demand access to the records at any time. Selling a recalled children's item is not a mistake. It is a violation. The Consumer Product Safety Commission can impose penalties that reach $100,000 per incident. The owner is now responsible for knowing the recall status of every donated crib, car seat, and children's toy that crosses the loading dock. The free inventory just became a compliance burden, and the government can fine the business for items nobody ever paid for in the first place. In Austin, Texas, an antique dealer bought a Roman bust from a Goodwill store for $34.99. The bust turned out to be an ancient artifact that had been stolen from a German museum decades earlier. The buyer was eventually compelled to return it. For the owner, the risk is not the treasure. The risk is the item that should never have been accepted in the first place. Police in Berthold, North Dakota, accidentally donated a bag of cannabis to a thrift chain while disposing of evidence from a closed case. The store became part of a criminal investigation through no fault of its own. A Value Village location received a donation of weapons that were later handed over to police as potential crime evidence. The store did nothing wrong, but the owner still had to explain the inventory to law enforcement. Every bag is a potential liability that cannot be fully screened. The risk is not visible from the outside. It is sitting in the donations accepted yesterday, and nobody will know about it until the police arrive or the lawsuit is filed. The liability does not stop at what arrives. The building itself becomes the weapon. Now add the building risks. A roof leak does not just ruin a rack of clothing. It ruins the electrical system, the ceiling tiles, and the customer trust that took years to build. A general liability policy covers a customer slipping on a wet floor. It does not cover the building settling, the foundation cracking, or the city deciding the occupancy permit was issued under the wrong zoning classification. Some cities classify secondhand stores separately from general retail. They can impose density restrictions or special zoning requirements that the previous owner never disclosed. The buyer acquires the lease, the inventory, and the goodwill. The buyer does not acquire the right to operate there because that right belongs to the planning department and it can be revoked. A single customer injury from a collapsing shelf can trigger a lawsuit that exceeds the entire annual profit. The settlement, the legal fees, and the increased premiums land on a business that was already running on a 4.1% net margin. Insurance companies know this industry carries unique risk. They price it accordingly, and the premium rises every time a claim is filed. The building that kills the business does not announce itself. It waits until the owner is fully invested, fully leveraged, and completely exposed. And at that point, getting out is nearly impossible. The standard exit multiple for a successful small retail operation might reach 4 times earnings. Apply that to the $12,000 profit, and the entire business is worth less than the van used for donation pickups. The buyer pool is narrow. A potential acquirer must qualify for a second-hand dealer license, pass the zoning review, and accept the same liability exposure the previous owner spent years managing. Most of those buyers are not investors. They are another operator looking for a better location or a larger donation base. That means the exit depends on finding someone who wants to run the exact business the seller is trying to leave. Getting out cleanly requires timing, a qualified buyer, and a business that generates profit above the owner's salary. Most thrift stores never reach that threshold. And this is where the math becomes impossible. The online resale platforms have already proven they can scale without a storefront. ThredUp processes millions of items through centralized warehouses, while the rent bill arrives every single month. A platform like that does not carry the lease, the liability, or the payroll. It carries a database and a shipping network. Consolidation is the other exit killer. The large chains like Goodwill and Savers control the donation pipeline through brand recognition and drop-off convenience. An independent store cannot match that intake volume. The store processes whatever the neighborhood leaves at the door, while the big operators process truckloads. The exit that looks like a sale often becomes a liquidation. The racking, the shelving, the point-of-sale system, and the van sell for pennies on the dollar. The inventory that seemed like an asset is actually a disposal problem. Unsold clothing has no wholesale market, and the textile recyclers pay by the pound. Most owners do not exit through a sale. They exit through a lease expiration, a donation to a nonprofit, or a quiet closing after the last customer leaves. What is this business actually? A thrift store is not a retail business. It is a waste processing plant with a storefront attached. The donation bin is the intake valve. The sorting table is the conveyor belt. The sales floor is the output channel for the small fraction of material that has resale value. Every ton of donated goods arrives free, but nothing about processing it is free. The labor to sort it, the space to store it, the utilities to light it, and the disposal cost to remove what cannot sell all land on the ledger. Industry data shows that 30% of donated textiles cannot be sold in the store. That unsellable material becomes a cost center with no revenue attached. The textile recyclers who take the unsellable bales pay by the pound, and the rate is thin. The operation is a reverse manufacturing line where the raw material is free and the finished goods are unpredictable. The store that wins is not the one with the best merchandising. It is the one with the cheapest processing cost per donated pound. That is why the nonprofit giants dominate. Their labor is subsidized by mission, and their real estate is often donated or tax-advantaged. A for-profit model competes against an operator whose cost structure cannot be matched because their intake is free and their labor is effectively free. The for-profit model carries rent, wages, and taxes that the nonprofit structure does not. The asset the buyer acquired was never the inventory or the racks. The asset was the position in the local waste stream. Control the donation flow and the business is controlled. Lose the donation flow and the store becomes an expensive room full of other people's discarded lives. The free inventory was never the advantage. It was always the liability. The racks are not profit centers. They are disposal mechanisms for a waste stream that cannot be fully controlled. The backroom online operation only works if the store gets first access to the donations before the nonprofits do. And the donation pipeline is controlled by brand recognition, tax deduction structures, and decades of trust that a new operator does not have. The racks of donated clothing look like a retail business. That is the illusion. What is actually visible is the final output stage of an industrial waste processing operation, where the margins are measured in pennies per pound. The competition controls the supply chain, the liability arrives in garbage bags that cannot be screened, and the exit is a door that only opens if someone willing to inherit the same problems can be found. The $13.7 billion industry is real. The 4.1% margins are real. The 80% failure rate is real. And now the reason is clear. The free inventory is exactly the problem.